Okay, I hope you are fine and everything is going on well. In our today's topic, this is topic G for paper 12, and we are basically going to be looking at audit procedures. So in this topic, we are going to be looking at how do we carry out audit procedures to verify the balances and the amounts that have been recorded in these financial statements. I remember right from the beginning we said that, as an auditor, you are there to verify the truth and fairness of the financial statements. And from our accounting, from our financial reporting, we know what financial statements are. We have the income statement or the statement of profit or loss. We have the statement of financial position. We have the statement of cash flows. We have the statement of changes in equity. And then we have the notes and the disclosures to the financial statements. So the income statement and the balance sheet are going to give basis for the other components of the financial statements. And you're going to find that most of the audit procedures are going to be focusing on the income statement items and also focusing on the statement of financial position items, and then a few procedures for notes and other disclosures to the financial statements. So our day's focus is going to be on auditing of revenue and receivables. You might ask yourself, why are we auditing revenue and receivables? But if you go back into accounting, you know that revenue and receivables work hand in hand. When you are carrying out a business, you are going to make sales. Okay, so the sales are going to either be on cash basis, that is give and take. Someone brings in money, he buys the goods from your business, and then they pay cash. And on the other side, we have the credit customers who are going to take goods from your business, and then they promise to pay at a later date. So it is the selling process that is going to lead to receivables, and therefore these two aspects of the financial statements work together. Remember, sales is in the income statement or the statement of profit or loss and other comprehensive income, while receivables are in the statement of financial position. And as such, or from what we have seen in the previous topics, the assertions for the income statement are going to be applying to revenue, and then the assertions for the statement of financial position are going to be applying to receivables. Okay, one thing we have to take note is that when management is making or is preparing financial statements, they are making assertions or they are making representations that the assets, the liabilities, the income, the expenses, and the disclosures are in accordance with the applicable financial reporting framework. This is what management is going to be saying. This is what management is going to be asserting. We all know that income and expenses, this is the statement of this is the statement of profit or loss and other comprehensive income. And assets, liabilities, and equity, this is the statement of financial position. So when you are carrying out your audit as an external auditor, your role is to make sure that you obtain sufficient and appropriate evidence with respect to all items of these financial statements, with respect to all assertions regarding these financial statements. And therefore, you have to make sure that the information that is being presented in these financial statements is true and fair, and it being true and fair means that it is going to be complying with all the relevant assertions. Maybe just a recap of the assertions. When we talk about the income statement or the statement of profit or loss and other comprehensive income, we are talking about completeness, basically meaning that all the revenues and expenses that are recorded in these financial statements are complete, or we have included all the revenue that we have earned in this period. Then we're going to talk about cutoff, where basically you're trying to validate that the transactions have been recorded in the right accounting period. We are not recording transactions for 2018 in 2019, and we are not recording transactions for 2019 in 2020. So basically, every transaction has been recorded in the period to which it relates. We also talk about accuracy, basically to ensure that the transactions have been correctly recorded in these financial statements. We do not have arithmetic errors. We do not have variances between the details of the transaction and what has been recorded in the financial statements. We do not have any errors like transposition, errors of omission, errors of commission, and so forth. You're trying to ensure that the transactions that are being recorded have all occurred in the period. There is no fictitious transactions. Very common practice is in people who may want to overstate revenue and they start recording sales transactions that have not happened. So you as an auditor, you've got to make sure that the occurrency assertion has been addressed with respect to a statement of profit or loss. And of course, presentation and disclosure or classification. You've got to make sure that the information has been presented correctly, has been classified correctly in these financial statements. Whereas on the other side of the balance sheet or the statement of financial position, we're dealing with assets, we're dealing with liabilities, we're dealing with equity. In the assertions applicable, completeness, basically to make sure that all assets have been recorded, all liabilities have been recorded, and all components of equity have been recorded in the financial statements as of the reporting date. The other assertion that we have is valuation, which is an equivalent of accuracy in the statement of on the statement of profit or loss and other comprehensive income. We're trying to make sure that these assets and these liabilities have been recorded at the correct values in the financial statements. If we take an example of maybe inventory, we have an accounting standard that prescribes the accounting treatment for inventory. And basically that is IS2, which says that inventory should be recorded at lower of cost and net realizable value. So when I am looking at this inventory from a valuation perspective, I'm going to be carrying out an NRV test to make sure that we have recorded this stock or this inventory in accordance with the International Financial Reporting Standards. We have standards like IS-21, which is going to be prescribing how you should be accounting for your monetary financial assets and liabilities. If they are foreign denominated, have you translated them into the reporting currency at the correct exchange rate? We have assets. Are you carrying them at some assets could be fair valued? We have assets that are going to be carried at cost. The non-monetary the non-monetary assets like property, plant and equipment. So you have to make sure that these have been valued properly in accordance with the applicable financial reporting framework. Then of course, existence, the assets are existing. If I am saying that I have 20 computers, are they actually there before I report them in the statement of financial position? If I'm talking about liabilities, are they all obligations of the organization? And also from a balance sheet perspective, we have the assertion of rights and obligations. If we are talking about assets, I have the rights over these assets that I'm reporting. This comes right from the conceptual framework for financial reporting, where we define an asset as a resource controlled by an entity from which economic benefits are expected to flow into the entity. So it is very important that before I start recognizing these assets in my financial statements, I am meeting the rights and obligations assertion with respect to these assets. When it comes to liabilities, do I have an obligation to pay? The conceptual framework for financial reporting defines a liability as current obligation arising from past events, settlement of which is going to lead to outflow of economic resources from the entity. So you have to make sure that the rights and obligations assertion has been addressed in the financial statement. Then, because presentation and disclosure and classification have these assets and liabilities been properly classified. We have current assets, non-current assets, current liabilities, non-current liabilities, and other classification information that has got to be complied with in presenting these financial statements. So those are things you're going to be after you as an external auditor while looking at this information. We have talked about the assertions for the income statement, and we have also talked about the assertions, the balance sheet. So in looking at all these aspects, for example, you're going to be looking at materiality. Materiality, we define it as something that influences, something that brings a change in the economic decision made by the users of the financial statements. And the risk, what is the possibility of the expected being different from the actual, or in terms of presentation, in terms of measurement, in terms of compliance with these financial statements. Then you're going to be looking at the relevant accounting standards and then the evidence that you have at hand. So we're going to look at the procedures specifically for looking at revenue and receivables in the remainder of this discussion. Okay, so if I am to talk about the procedures for auditing revenue, I need to first understand the sales process. What happens? The sales process, probably you're going to have this customer placing an order with you as an organization. You may need to check if you can fulfill this guy's order. You need to look at the volume of the order that your customer is placing. After you look at if you can fulfill the order, then you're going to look at the selling prices that you're offering to this customer, what are his deliverable timelines, and you're going to advise maybe the dispatching department about the order. You can confirm the order, then you can deliver the goods to the customer. Once you deliver the goods to the customer, you've got to get them to acknowledge receipt of the goods. And then after him acknowledging receipt of the goods by maybe signing on the delivery note, then you've got to raise an invoice. And after raising an invoice, this customer is going to pay you, then you will have a receipt of cash. If he's a credit customer, then you're going to have the whole process of managing your receivables, as you're going to be recovering the money at a later stage in future. So you have several stages of this whole process, and you have different people involved in this process. And it is very important that this whole process is properly controlled, properly regulated, if you're to have minimal errors. For example, who is in charge of receiving customer orders? How do they receive them? How do they pass these orders on to the dispatching department? The dispatching department, what controls do they have in place to make sure that they dispatch the right quantities as ordered by the client? Once they dispatch the quantities, how do they get the goods delivered to the customer? How do they confirm that goods have been delivered to the customer? Then on our side, when we deliver goods to the customer, how do we bill the customer? Who records these transactions in the sales table? Who records these transactions in the general ledger? Who reconciles these transactions? Who reviews these transactions? And at the end of the day, we can say that we have the right numbers in our books in terms of the sales that we have recorded. So it is a very short process, but for it to give you the right results in your financial statements, it must be operating with the controls that ought to be operating at every stage of the cycle or at every stage of the process. So let's look at some of the procedures that the auditor can carry out to make sure that the sales figures that have been recorded are exhibiting all the assertions for the statement of income and expenditure or the statement of profit or loss and other comprehensive income. One, you can carry out tests on invoices, credit notes, dispatch notes to ensure that all of them have been recorded and there's no omission or duplication. Now, how do you do this? For example, here you can clearly see that this person is trying to address the completeness assertion. I am carrying out a check on my invoices and maybe dispatch notes to make sure that all of them have been recorded in the financial statements. You can look at the sequential numbering of these documents. For example, if they are sales invoices, what is my first invoice for the financial year? What is my last invoice for the financial year? And are all sequential numbers included in my general ledger? If there's any number that is missing, what does it relate to? Why is it missing? Has it been recorded and then subsequently reversed, or maybe a credit note issued against it? If that has been reversed, why has it been reversed? Or is it just an omission and therefore my revenue in the financial statements is not correct? So it is very important that you carry out that check on invoices, credit notes, and ascertain that there is no omission and the financial statements are having complete revenue. It is also very important that you check for authorization of orders, dispatch notes, raising of invoices, credit notes, pricing, and discounts. Authorization of orders, first of all, makes sure that all orders that are being shipped out have been approved by the organization or have been approved by the company. Dispatch of goods. Authorization is a control. I'm trying to make sure that what has been ordered and confirmed is what is leaving the warehouse. Raising of invoices. Who is raising the invoices? Are they being reviewed and approved? And if they're being reviewed and approved, that is going to ensure that the errors being made in the financial statements are actually minimal. Just imagine a situation whereby maybe you have an account assistant and he raises invoices and credit notes and nobody reviews them. You could have very many errors. There could be arithmetic errors, there could be any other errors that can be made and they end up making the financial statements incorrect. But if you have a second pair of eyes reviewing and authorizing, then that could make sure that the financial statements are not materially misstated. Check the arithmetic accuracy of the invoices, credit notes. You can get samples of invoices and credit notes and confirm that people are computing things rightly. Things like VAT are being excluded from the revenue that is being recorded in the financial statements. Sequential numbering of invoices to ensure that there are no missing numbers. That is already talked about. You can inspect copies of cancelled invoices. If someone wants to commit fraud in revenue, probably they are going to start issuing maybe fictitious credit notes, fictitious invoice cancellations, maybe in a bid to reduce the revenue recorded, and maybe misstate the tax filed with the tax body, things like those. You need scrutinized credit notes for large and unusual items. Credit notes are issued if there is an overcharge, okay? So if there are, or if say there are sales returns, okay, so you need to make sure that whatever credit notes or whatever reversals are being made in the revenues account have been validated to be true and correct and accurate. And they are actually relating to reversals that are eligible to be made in the accounting system. Then you can compare total revenue on a month-by-month basis against prior years and budget, and look at any significant fluctuations. This is more of an analytical procedure. You're basically trying to look at the trends within the revenue. If I compare my revenue for the current year and the previous year, are there changes? And if there are changes or the fluctuations or differences, how do they relate to the actual context of my business operation? Because that is going to give me an idea of if there could be movements, relationships that are actually showing that there are material misstatements in the financial statements. For example, if my business has relatively not expanded, it has remained at the same level, maybe for the last 5 years, I expect revenue to maybe be relatively the same since there's not been significant changes in my size of operation and my nature of business and what I'm dealing with, so what I'm dealing in with my customers. Otherwise, if I have unexpected relationships in numbers from one year to another, it could actually be an indicator that my sales recorded may not be correct. They may not be relating to sales for the year. And also it's very important that you look at the product-wise breakdown of revenue. It's also an analytical review, and you discuss any unusual movement. So I can do my analysis by current year, prior years, and I look at the relationships. I can also look at my analysis after breaking down the revenue product-wise, and I see if there are any unusual relationships, basically to confirm the currency, accuracy, and completeness of the sales revenue recorded in the financial statements. We have a very interesting check. It's also an analytical procedure of looking at the gross profit margin for the entity. I normally use this example in most of the classes, whereby I mentioned that the gross profit margin can only and only change if you change in your selling prices or if you make a change in the cost of your inputs. Otherwise, the gross profit margin is supposed to remain the same. Let me just do a simple illustration for you. We're going to take a look at this Excel. Try to demonstrate something for us here. This is my 2019. This is my 2018. Let's say I did in the selling cars. Okay. Cost from maybe Japan is 300 million, and my selling price is 400 million. Okay. Okay, fine. So assuming in 2019 I come and sell 10. In 2018 I sold 5. Okay. My cost, my revenue in 2019 is going to be 4 billion. Okay. It is 10 times 400 million. And then this is my revenue. And then my cost of sales is going to be 10 minus times 300 million, which gives me 3 billion. On the other side, So the gross profit is 1 billion. The gross profit margin is 1 billion out of 4 billion, which is 25%. So if I go to my 2018 and maybe I sold only 5, the revenue is supposed to be 2 billion. Cost of sales is supposed to be 1.5 billion, and my profit is supposed to be 2 billion minus, and my gross profit margin is supposed to be 5%. So what does this mean? This means that at any one point in time, unless I change my selling price or cost price, my gross profit margin is supposed to be at the same. So what this does is that should I come and I forget, and maybe I make a mistake in my revenue, and here I have 2.1 instead of 2 billion maybe, and the auditor gets 29% as the gross profit margin, is going to inquire from me, of course, what happened? I see your gross profit margin is going up from 25%, sorry, is going down from 29%, this is 2018, and 2019, it is 0.25. Is there any problem? Let me just make this 2018, and I make this 2019. So you're going to come and be doing this analytics. You're trying to compare the gross profit margin for 2019 and the gross profit margin for 2018. So what is happening? You're auditing revenue, remember. How comes the gross profit margin is increasing from 25 to 29? Do you change your prices? Maybe no. If you didn't change the prices and you can't explain why the gross profit margin is increasing, then you have a problem. If you didn't change the prices for selling, or if you didn't get a cheaper or different cost supplier, okay? If it can be explained, well and good. Maybe we change the prices from this to this, and when you try to relate it to the business, it makes sense. But if you didn't change prices, if you didn't change the cost, then this is an indicator that your sales are wrong, and you can go in and carry out other tests to confirm what is the misstatement, and then you correct it before you issue the audit opinion. So you're carrying out this analytical procedure. It is very, very important. It is going to help you to know if the sales occurred, if the sales are accurate, and if the sales are actually complete in the financial statement. Of course, you've got to get some sales invoices, and you check the supporting documents like sales invoices, which shows that the sale has been recorded. Then goods delivery notes, which show that the customer has received the goods. The goods delivery note from the supplier is supposed to be signed by the customer who is receiving the goods. You can look at the prices. Are they matching with the company's approved price list? In terms of arithmetic accuracy, are they adding and casting and done properly on the invoice? And you can trace the amounts on the invoices to the general ledger. You're trying to validate if the amounts that are on the invoices or the documents or the support documents are actually matching the amounts recorded in the general ledger, and we do not have any things of like errors while transferring information from the source documents into the financial statements. Confirm that the customer orders agree to the goods dispatched. You don't have any errors on either ends. Confirm that cash receipts are complete, because this is what is going to validate your cash sales. And get a sample of credit notes and check the supporting documents to ensure that the correct sales returns have been deducted from the sales and credit the respective receivables account to ensure that the sales returns are actually correct. So you need to make sure that for credit notes that we are talking about, the sales returns are matching with the credit notes. Otherwise, if I receive only 2,000 units and I issue a credit note of 3,000 units, then I'm going to understate my credit notes, and the result is that I'm going to understate the sales revenue. And of course, you need to look at the dispatch notes after year end and check these that they were invoiced to receivables in the correct accounting period, because you would wonder, why would someone be raising the credit? Was he trying to do a little bit of profit smoothing? He's just booking them for the sake, and then after the year has closed, he's going to reverse them and book them in the future. Then check that the invoices have been properly classified in the chart of account. That is the classification assertion for revenue in the financial statements. Okay, I hope audit of sales is very clear, and you can run through these procedures. If you have any issues, if there's something you're not getting very well, feel free to contact and raise your questions, and they will be answered. Let's take a look at receivables. Receivables, we said that this is a balance sheet item, okay? And you are interested in verifying several assertions. One is completeness. You want to verify that the receivables reflected in the financial statements are actually complete. They include all the amounts that are receivable from the entity's customer. Of course, the first thing is, for all items in the financial statements that are balance sheet, the number one thing I think is to agree this information to the supporting listings or schedules to ensure that they are accurate. If you're saying that my assets value is 30 billion, can you give me a breakdown of the assets that makes up 30 billion, not just having one block figure, because there's going to be a lot of testing on this schedule, because this is what is leading to this balance. So get a schedule of receivables, cast it, and make sure that it agrees to the general ledger. If you're auditing the general ledger which does not match with supporting information or schedules, then it's going to be very problematic. You need to inspect agreements and correspondences with third parties and compare the amount of prepayments the previous year, and review if it is reasonable to leave the prepayments in the financial statements. Normally, prepayments are those situations where you're going to maybe pay in advance for the services that you have not yet used. And of course, they've got to be having support documents, maybe agreements or correspondences from these third parties that you're dealing with are in your business. Then when it comes to existence, you're basically trying to ensure that these assets that you have in the financial statements are actually existing, or these receivables that you have in your financial statements are actually existing. And one of the things that you can actually carry out is to carry out confirmation procedures, whereby you send out confirmation letters and request customers to confirm their balances. The expectation is that if these customers are there and therefore the balances are there, they are going to respond and confirm. The number two that you can carry out is to look at the subsequent payments. Yes, you're saying that Victor owes you 300 million as of 31st of December 2019, okay? But subsequently, maybe in January and February when I'm carrying out the audit, has he subsequently paid some amount? The expectation is that a customer who is actually there, who is not a fictitious balance, is going to pay. So if there is subsequent payment from Victor, which you can review and confirm to the bank statement, then you can conclude that this balance actually does exist. Rights and obligations, still performing confirmation of receivables at the year end is going to confirm this. If you request me, the customer, to confirm that the entity you're auditing, I owe it 300 million, and I do confirm, it basically means that this entity has rights and obligations over this balance that is due from me. Inquire from management about the rights to receivables. They could be receivables that maybe have been pledged as security for borrowings. We have certain kinds of financing that are going to create floating charges. So discuss with management and let them confirm if there's any arrangement as this so that you can treat and disclose properly in the financial statements. When it comes to valuation and allocation, you're trying to ensure that these receivables in the financial statements have been recorded at the correct amounts. And the risk with receivables is mainly being overstated. You record that you have a receivable of 20 million, but someone turns out not to pay, and therefore it's a bad debt. So you need to make sure that you are prudent and conservative in recording your assets. So one of the things is you can look at the receivables days, you compare with the previous year and investigate any significant variances. Receivables days basically give you the number of days you take to convert your receivables into cash. Okay, if your customers are taking long to pay you, then it means that most likely some of them are going to fail to pay you, which of course is going to put question on what figures you're recording as your receivables. Look at the provision for bad and doubtful debts. Is it accurate? Does it make sense? Is it adequate in these financial statements, or is it not adequate and therefore you need to increase the provision for bad debts? Look at the bad debts expense as a percentage of sales, that of the previous year, and see if there are any significant variances. Are there any bad debts written off? Look at reasons for write-off. Are they just writing off for fun, or have they gone through the right process when it comes to writing off these balances from the books? Someone could end up writing off a bad debt that is actually recoverable, but maybe they have their own other motive of misstating certain sections of the financial statements. Look at board minutes, see if there are any disputed invoices. If you have this customer of 300 million and he's saying, me, I only owe you 200 million, then it means the 100 million is already in question, and therefore it may need to be written off. I don't know, but look at what the board is saying with respect to receivables, and have there been any approved write-offs of bad debts, and let's get this done. Look at the credit notes issued after year end and make sure that these were receivables in the previous year. Because if we have credit notes being issued after year end, but they're not from receivables before year end, then that means we could be having a problem. We could be having transactions that are not feeding into the financial statements correctly. Look at the conversion of foreign denominated balances. If it is a receivable of 1 million US dollar, has it been translated into the reporting currency using the correct exchange rate? This is very important to verify. Classification and understandability. You're making sure that this information is properly classified and it can be understood by the users of the financial statements. And how are you going to do this? You're going to look at the financial statements and read the disclosures and ensure that the current and non-current receivables are properly segregated. I think that is very clear. You have a section for current liabilities, non-current liabilities, current assets, non-current. So in this case, we are mainly focusing on current and non-current receivables in the financial statements. Credit balances have been properly classified as current liabilities. We have cases whereby someone is a customer, but maybe he has paid you in advance, and therefore his account has a negative balance. You're not allowed to do a netting off effect in accounting. If he has a credit balance and he's a customer, this should cross over to payables because you have liabilities to pay. Then ensure that the receivables are properly classified in the financial statement. We are not having trade receivables under prepayments. We are not having insurance receivable under trade receivables. So make sure that is put together. Within receivables, it's not only the trade receivables, we can also have other receivables. For example, things like prepayments, those need to be looked at with a different approach. So their procedures mainly are going to be ranging from just getting a schedule and making sure that it agrees the trial balance. Look at the arithmetic accuracy of the schedule. If someone has computed prepaid rent, has it been computed correctly? Look at the supporting documentation for significant items. Maybe have a security bond of 2 billion. Just confirm it. Make sure that there is actually certificate of deposit with whoever the bond was being issued. Then look at the circumstances. Relate to the date and whether it is going to be recovered. We have cases of, for example, staff loans. Someone gives the staff a loan and the staff disappears. Or is that receivable still existing or that receivable is not existing? You need to look at that. If it's not existing, then you need to know how to deal with it. If there are any rent was paid in advance, inquire into arrears and how sure can we be that this is going to be looked at. Seek for permission to obtain direct confirmation of balances from tenants and staff. You can do a confirmation by yourself to make sure that the tenants and staff, the information that is coming from them is exactly the same as the information that is coming in or out of the financial statements. Then you need to reconcile, of course, confirmation replies, and then determine whether additional provision for bad debts and doubtful debts are necessary. So it's very important for you to carry out confirmation. Once you carry out confirmations, then now you can review them and see if they are up to date with respect to the tax body. And see if there is any, when you look at the replies and look at the additional provisions for bad debts, okay, and you're going to have to be able to confirm. I have confirmations from customers, okay, and what are they saying? Are they disputing some amounts or are they not disputing amounts? So if they are disputing some amounts, maybe this is what is going to lay basis of areas where I need to make additional provisions for bad debts and reconcile those that can be reconciled. If there's need for provision for bad debts, I make them. If there's no need for provision for bad debts, then maybe there's no material difference, and I'm very happy to continue. So then for staff loans and advances, check and confirm that these were authorized, check that they are within limits, check for recovery, check for security placed against loans, and pay attention to unsecured ones. So for example, if I'm a bank, my receivables are going to be the loans. So is there security? And if there's no security, what are we doing, or what are we ensuring? What are we doing to ensure that we do not miss anything, or we don't lose our money because the security is not proper, or the security is not properly perfected, or the process for following up with a customer is just not robust at all. Okay, thank you very much. So this has been our discussion for trade receivables and revenue. Until next time, that we are going to be adding on audit of expenses and payables. Thank you. Thank you so much. If you have any queries, please do not hesitate to ask.